After months of sliding, Riot Platforms is finally showing signs of life. The stock has bounced over 30% off its 2024 lows, reigniting investor interest as Bitcoin stabilizes above $60,000. But is this a true turnaround, or just another relief rally? Riot is a top US-based Bitcoin mining company known for its massive Rockdale facility and renewable energy strategy. With power credits, strategic infrastructure, and a strong balance sheet, the fundamentals look promising. But crypto mining remains volatile, and headwinds like regulation and market sentiment still linger. So, let's dig in. Is Riot's rebound real, and should investors be buying the dip? Before we break it all down, hit that subscribe button and join the Stocks Telegraph crew. And drop a comment below. Are you bullish on Riot or still skeptical? Riot's recovery isn't random. It's supported by improving sentiment, macro tailwinds, and operational wins. The stock recently surged over 30%, breaking above key moving averages and testing resistance zones. These are classic signals of a trend shift. Bitcoin's rebound past $60,000 has also boosted miner profitability. With lower mining difficulty and decreased hash rate competition, especially after China's recent crackdown, US-based players like Riot are gaining ground. Company-specific momentum is helping too. Riot's Rockdale facility is one of the largest in North America, and recent earnings topped expectations. Add in power credits from ERCOT and consistent operational updates, and the bounce looks more than just speculative noise. On top of that, broader interest in crypto infrastructure has been growing. Institutional investors are warming back up to the sector as ETFs gain traction, and macro fears around inflation and currency devaluation drive more money into digital assets. This climate favors Bitcoin, and by extension, miners like Riot. Riot shines in a competitive mining space thanks to its scale, cost advantage, and renewable footprint. While rivals like Marathon Digital, Mara, and Hut 8 focus on expansion, Riot's cost per coin, roughly $44,000, beats Mara's $50,000 plus and Hut's $60,000 plus. Its Texas-based Rockdale facility gives it 700 megawatts of capacity, an unmatched infrastructure edge. And with long-term power agreements in ERCOT, Riot can control energy costs, critical in an industry where margins are razor-thin. Compared to Iris Energy and other sustainable miners, Riot combines scale with cost efficiency. It's a rare mix, and one that could offer long-term upside as the mining sector matures. Riot's US base also adds a regulatory and geopolitical hedge. While overseas competitors face more uncertainty, Riot can scale with more stability, especially if domestic policy favors American-made Bitcoin. Riot's upside hinges on two things: Bitcoin momentum and operational leverage. As BTC rises, Riot's margins expand rapidly. In 2024, Riot added over 17,700 BTC to its reserves, a 141% increase, positioning it to benefit big from future price hikes. Riot also monetizes energy. In 2023, it earned $71.2 million in power credits from ERCOT, over 25% of total revenue. This strategy transforms energy volatility into a revenue buffer, and its balance sheet is solid. $3.94 billion in assets, only $791.6 million in liabilities, and over 19,200 bitcoins held as of early 2025. That kind of strength allows Riot to scale without over-leveraging. Regulatory risk is a big one. In early 2024, Riot sued the Department of Energy over emergency data demands. This underscores the rising tension between miners and regulators, especially around power usage. Riot's fortunes are still closely tied to Bitcoin's price. Despite BTC climbing to 67,000 plus in early 2024, Riot stock dropped 33%. Proof that investor sentiment doesn't always move in sync with crypto prices. Margins could also get squeezed if energy prices spike again, or if Bitcoin's next halving, expected in 2028, hits miners harder than anticipated. These uncertainties remain part of the package. Riot had a strong first quarter of 2024, posting $211.8 million in net income and $0.82 EPS, driven by a 55% jump in mining revenue. But second quarter saw a swing to an $84 million loss, largely due to Bitcoin halving and increased hash difficulty. For all of 2024, Riot mined 4,828 BTC, down from 6,626 in 2023. Its cost to mine a single Bitcoin jumped from $3,831 to $32,216 due to reduced power credits and network difficulty. Still, it remains under the industry average of 55,950. Riot's BTC reserves, now over 17,700 coins, are worth $1.7 billion at a $93,000 BTC price. But with revenue tied to volatile assets, investors should watch earnings variability closely. Add to that its relatively low debt levels and strong liquidity position, and you've got a company with the tools to withstand a downturn and pounce on new opportunities when conditions improve. As of April 10th, Riot trades at $7.38, below both its 50-day $9.24 and 200-day $9.85 SMAs, signaling a bearish trend. The RSI is 34.68, nearing oversold territory, and MACD remains negative. Resistance sits at $7.42, support is at $6.63. Volume has spiked above average, possibly signaling accumulation. D.E. Shaw's recent stake adds credibility to that theory. Despite mixed signals, technicals suggest Riot is approaching a potential inflection point. Whether it breaks out or breaks down may depend on BTC's next big move. Analysts are cautiously bullish. Riot holds a buy consensus from 12 analysts with a $17.18 average target, offering 132% upside. Targets range from $13 to $23. Institutional support is growing. Hedge fund D.E. Shaw added Riot, and it's also featured in the Valkyrie Bitcoin Miners ETF GMI. Retail interest is rising too. Reddit mentions jumped 145% in a day. Still, sentiment is mixed. Despite rising chatter, Riot dropped over 10% during that same period, showing that retail buzz doesn't always translate to buying pressure. The divergence between institutional positioning and retail volatility adds a layer of complexity. For some, this means an opportunity to front-run broader sentiment shifts. Riot's recovery has technical legs, macro momentum, and strong fundamentals behind it. But crypto stocks are always a high beta bet. For Bitcoin bulls, Riot is a leveraged play on BTC price action with a solid balance sheet and proven cost efficiency. For traders, the recent bounce and oversold RSI may present short-term upside, but be wary of resistance and macro whipsaws. For value speculators, Riot looks undervalued relative to Bitcoin reserves and hash power, but regulatory noise and dilution risks still apply. Ultimately, Riot isn't for the faint of heart, but for the right investor, it might be one of the best risk-reward crypto equities on the board. And with rising hash power, infrastructure scaling, and Bitcoin adoption accelerating, Riot could be entering a new phase of growth that rewards early conviction. Riot is back in the green, but is the recovery for real? Are we witnessing the beginning of a long-term trend reversal, or just another short-lived rally in an ultra-volatile space? That's the big question, and we want to hear your take. Are you buying the dip or waiting for confirmation? Drop your thoughts in the comments. We want to hear what you think. And if you're into crypto stocks, high-risk, high-reward plays, and smart market timing, smash that like button, subscribe to Stocks Telegraph, and ring the bell for more deep dives every week. Thanks for watching, and we'll see you in the next one.